the summer, many of the home builders started rallying in anticipation of rate cuts from the Fed. But now the Fed started cutting, and the group keeps rolling over. So what's going on here? Didn't we want rate cuts to jolt the industry out of the doldrums? Well, let's look at what happened when some of the key home builders recently reported. First, we got Lennar, the Miami-based developer that's become one of the largest home builders in the country. Lennar kicked things off last Thursday when they reported after the close. On the conference call, management acknowledged that with an easier Fed, investors had begun to expect and anticipate an improved housing environment, hinting that we might be seeing the beginnings of that now. However, Lennar quickly threw cold water on those hopes, following up these comments by stating, and I'm going to quote here, "With that said, our third quarter results reflect the continued softening of market conditions and affordability through our third quarter," end quote. Ouch! Not exactly what investors were hoping to hear. Lennar posted weaker than expected revenue with lower than expected deliveries and average selling prices that were merely in line with expectations. The housing gross margin, 17.5%. That's 30 basis points lower than anticipated, 500 basis points lower than the year before. Needless to say, the earnings were not that good. Even worse, Lennar says their earnings for the current quarter are likely to come in below the expectation. And remember, Lennar is a fantastic company. As management explained on the conference call, while they ultimately delivered more units than they expected last quarter, those sales required additional incentives to lure people in which is what crushed the gross margins. Incentives mean, of course, they cut the price in order to get people to buy. Going forward, Lennar wants to be less promotional, but who knows if they can really make it happen. So if you were looking for some unapologetically positive commentary on the state of the housing market, Lennar, Stuart Miller, CEO, he didn't give it to you. While some investors were hopeful that just the expectations of lower interest rates would be enough to jumpstart sales, management took much more of a curb your enthusiasm approach. Listen to this. Quote, "Even though mortgage rates began to trend downward towards the end of the quarter, stronger sales have not yet followed." However, they also talked about, quote, "early signs of greater customer interest and stronger traffic entering the market," end quote, and said that interest rates continue to fall. They're quite optimistic that stronger sales activity will come soon. So maybe you want to call it green shoots and that things can get better if rates continue to come down. Could be worse, but it's not what the bulls were really hoping for. On a more optimistic note, management acknowledged that because of the extended period of high interest rates, Lennar has been forced to cut its construction costs in an effort to make housing more affordable. Going forward, management believes this leaner cost structure will allow them to clean up once the housing market rebounds, and they're pretty confident that as mortgage rates approach the 6% level or lower, demand really will start to kick in. Buy. Right now, we're at roughly 6.4% for a 30-year fixed mortgage. Now, that's far cry from 7%. Plus, rates we were getting, those are the rates we were getting at the beginning of the year. But you see, it's still up slightly from the sub 6.2% level we had just before the Fed cut rates. Like everybody else in the industry, Lennar needs lower long-term interest rates. Usually when the Fed cuts short rates, long rates will come down too. But that's not always the case. Last fall, for instance, the Fed cut short rates and long rates skyrocketed. Worth keeping in mind. I mean, I know I'm very concerned that we could repeat last year's fiasco as long rates are still creeping up higher after that last recent rate cut. That's not good. Next up, KB Homes reported last night, and even though it was another really good home builder, by the way, even though it's more encouraging than Lennar, it wasn't that much better. KB Homes actually posted notably better than expected sales. Average selling price came in a bit above expectations, too. Better than expected deliveries, although both of those were still down year over year. The gross margin also came in ahead of the consensus estimate, leading to a nice bottom line beat. Despite those generally better than expected results, though, KB Homes still cut their full-year sales forecast by a sizable amount. How about the commentary? Management's adamant that the long-term outlook for housing remains favorable, driven by both demographics and shortage of homes. As for the shorter-term outlook, KB Homes saw some positive signs starting in June with price stability and demand, and that continued as the quarter progressed. They also find the decline in mortgage rates encouraging, although apparently not encouraging enough for them to maintain that full-year sales forecast. Still, management did something I thought was very useful in the conference call. They broke out in detail what lower mortgage rates mean for their business and for the customer. Mortgage rates have fallen roughly 60 basis points from earlier this year, and the company says that adds $30,000 of purchasing power based on their average selling price. Now, that's a good chunk of change, especially for the first-time home buyers or those looking to upgrade for the first time, groups that make up 70% of KB Homes customers. This is, a group of more moderately income people. The company seems to be taking a different approach than Lennar, which got very promotional last quarter in order to sell more units. KB Home maintains they don't need to chase incremental volume right now. Currently, they say spec builders, are discounting heavily to close out the year, and they don't want to crush their own margins by trying to compete with that. That said, while management noted that orders have been good, they also said, quote, I wouldn't say that we've seen a big uptick yet, or maybe the uptick that we would expect to see from such a change in mortgage rates. Nah, not ideal. As for why that's the case, listen to this, quote, I think to some extent buyers are in maybe a bit of a wait-and-see mode, end quote, noting that potential home buyers might be waiting for rates to come down even further before they pull the trigger. And I think that's exactly what is happening. Exactly. See, they'd rather, KB Homes would rather buy back stock if it comes down a little bit more than just put up homes for the sake of putting up homes, especially if the gross margins are going to decline, as they think would happen in December. So what have we learned from these home builders so far? In short, based on commentary from Lennar and KB Home, the bulls clearly got ahead of themselves here, because so far we haven't seen any meaningful increase in sales volume driven by lower mortgage rates. So let me give you the bottom line here on this really important industry, as I said at the top of the show. Lennar and KB Home need lower mortgage rates in order to win, and both companies sounded optimistic about the prospect of those rates coming down. But man, ever since the Fed cut short rates last week, long rates have been on the rise again. That's why I think it's better to take a wait-and-see approach to the home builders, just in case we see a repeat of last fall, where the Fed started cutting and it didn't make a difference. If anything, it drove the bond market in the wrong direction and mortgage rates higher. Their money's back after the break.
Coming up, tax on top again. But is this a 2000 redux? Forget the boy bands and low-rise jeans. Cramer is taking to the charts to see what the rally's really signaling. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.